Thank you for watching this video. Today we will be doing technical analysis on the stock market for Tuesday, May 11th, 2021, and this is going to be a little bit of a different video because I'm shooting it intraday. It's just about 10 minutes till 11 a.m. Eastern Standard Time on Tuesday the 11th, so keep in mind that this is intraday. Prices by the end of the day are probably going to change one way or the other, and even as I'm shooting the video, as I update some of these charts, the intraday prices will change. As always, for this analysis, I'm going to be using stockcharts.com. That is the charting service that I use and pay for. I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Now, for this analysis, we will be looking at the S&P 500. We will also be looking at the triple Qs. Of course, that's the ETF for the Nasdaq 100, and we will also look at the IWM, which of course is the ETF for the Russell 2000 Small Cap Index here in the U.S. Let's start off with a one-day, one-month chart. So this is a daily chart. Each candlestick represents 1 day of trading, but I'm only going to go back 1 month because I really want to focus on what's happened over the last couple of days. The market, right, the S&P 500 hit a new all-time intraday high of 4238.04 on Friday the 7th and closed at a new all-time closing high. I just abbreviated that ATCH, all-time closing high, 4232.60 on Friday. Well, we didn't get any follow-through, which is always important when you're doing this type of work, right? If you see something happen, you want to see follow-through. And on Monday, the market was down big, and of course today now, as of right now, we're down 1.55%. on the S&P 500 so far. Again, it's a few minutes before 11 a.m. here on Tuesday the 11th, but we're down over 1.5% on the S&P 500 so far today. Again, we could finish, higher or lower than that, right? Not down as much or down more by the end of the day. But I wanted to get this video out as soon as possible because there's some things changing, right? Potentially changing in the markets. But what we do know, of course, is we did not get the follow through on that all-time closing high on Friday the 7th, both all-time intraday high as well as closing high. So that, is a little bit concerning. However, I'm going to show you on some support and resistance charts on some shorter-term time frames, 5 minutes, hourly, things like that, that we may still be okay, but there's definitely some levels to watch, and we'll take a look at that over the next few charts. All right, so the next chart we're going to look at is a 5-day, 5-minute candlestick chart of the S&P 500. The blue line is set at 4220, and you'll see over the course of this chart and the next few charts why that 4220 level is so important. I did just refresh the screen, and we are now down 1.42% on the S&P 500. Of course, we were down a little bit more than that on the previous chart, keeping in mind that I'm shooting this stuff intraday. The stock market is open. I don't do a lot of these intraday analysis videos for you guys, but I just felt like it's super important here what's going on right now. But 4220 is the area that we first got above on Friday the 7th, and you can see that we really only held that level for about a day and a half. We fell beneath that on Monday the 10th, just about 2:10 or so, a little after 2 p.m. on Monday the 10th yesterday. And of course we closed at the lows of the day yesterday, which was not a good thing, and then we gapped down at the open today, and you can see today's trading thus far on the S&P 500. But going back here to the middle of last week, Wednesday, Thursday, and of course Friday, you can see the price action there. We got above this 4220 level, but we have been rejected here, and we'll talk about this. So this, at least in the short term, this 4220 level will very likely become an overhead resistance point that may give us some fits as we try to get back through this level, whenever that is. The next chart that we're going to look at is an hourly candlestick chart of the S&P 500 that starts on April 8th. And of course is still live here as I'm shooting this on Tuesday the 11th. What I really want you to take away from this chart is, since we first got above the 4120 level, that's this lower blue line, back on April 9th, on an hourly basis, we've only had either one or two. That's just been one or two right back in here hourly candles since clear back on April 9th that have closed below 41.20. So on the hourly charts, guys, 41.20 becomes a very important support level. And you can see what has happened today is the tail of this candle, at least so far, has gone below 41.20. But on the hourly candles, we are still, as far as the body, right, the closing prices, we are still staying above that 41.20 level. So, you know, so far, from a traditional technical analysis standpoint, we are staying above the support level that has been in place for over a month now. Again, that goes back to April 9th. But 41.20 is holding up there. And you can see that the 42.20 level, right, we kind of got rejected just underneath that at 42.1878 back on the 29th. That's this right here where I put a circle on the wick of that candle right here. Again, these are hourly candles on the S&P 500. The blue line at the top here is 42.20, and this 41.80 level, we'll talk about that. That's been kind of a support and resistance level as well. But we got rejected right here, pulled back, and then got above the 42.20 level, as we've already looked at for about a day and a half, and that didn't hold. So this, in the short term at least, is a negative sign that we have been rejected at this 42.20 level. So that 42.20 level, we know now it's going to be tough, right? At least in the short term, to get back to that level and start to successfully close on an hourly and then daily basis above that. But whenever that is, whether it's a few days, few weeks, or a few months from now, whenever it is, whenever we start to close above 42.20 on a consistent basis, that will be a very good sign that the market has put in enough of a base right below that level, and then we can start to move higher and go to 4240 or I'm sorry 4440, 4500, and then at some point, right, whether it's this year or next year, perhaps even S&P 5000, but that obviously is some point in the future. All right, so what we do know, again, and I'll refresh the screen in a second, is we are at least consistently staying for right now above this 41.20 level. So on the hourly charts, 41.20 will be an important level to watch. 41.80, real quick before we move on to the other chart, you can see that we got right around this 41.80 level and then pulled back, right? We got rejected there, much like we're being rejected right here at this 42.20 level right now. We got rejected at 41.80 back on the 16th of April, and then on into Monday the 19th, and market fell back down to that 41.20 support level, and just like a ping pong, right, we kept going back and forth between this level, got above it, got clear up to this, right close to this 42.20 level, got rejected, pulled back, and then finally, right, we got above 42.20, but the market couldn't hold it, the S&P couldn't hold it, and here we are pulling back once again to this 41.20 level. Of course, the tail of the candle has dipped below that, but so far, the bodies of the candles on the hourly charts have stayed above 41.20. So keep an eye on that 41.20 level on the hourly charts. If we stay above it, we're probably going to be okay. If we start to close below it, then we know that the market is indeed weakening and things are likely to get worse. The next chart that we're going to look at is a daily candlestick chart of the S&P 500 that goes back 7 months. The horizontal blue lines are set at 39.75, and the short one is at 41.25. The wiggly, right, the squiggly blue line is the 50-day moving average. This one here, that's the 50, and the green line right here, that is the 200-day moving average. So let's start over here in the upper right-hand corner. I just refreshed the screen as of right now, which is straight up 11 o'clock Eastern Standard Time on Tuesday, May 11th. We are down 1.41% right now on the S&P 500. And we just looked at the fact that on the hourly candlestick charts, the support and resistance level has been around 41.20. On the dailies, it's at 41.25, okay? So you can see here this short line. There's not a ton of support around 41.25, but we know since we got above this level and during the second week in April, we've been able to successfully stay above, and as you can see, close above this level on the daily charts, just like on the hourlies above the 41.20 level. On the dailies, it's above the 41.25. So there is some support at 41.25. So on a daily basis, as long as we can continue to close above 41.25 on the S&P 500, there's probably not a lot to worry about. If we start to close below 41.25, the logical pullback to areas would be the 50-day moving average, which right now is setting just below 40.50 on the S&P 500. And then if we start to close below the 50-day moving average on the S&P 500, 39.75 would be that next support level. And of course, the 200-day moving average. It's pretty common most years, not every year, but it's pretty common for the S&P 500 to pull back to the 200-day moving average at least once or twice a year. Most years, again, not every year. So, maybe we're going to get lucky, right? Maybe 2021 we don't see the S&P 500 pull back to the 200-day moving average, but we have to be open to that being a possibility. So on this chart, the takeaway is, as long as on a daily basis we continue to close above 41.25, and right now we're at 40. I'm going to refresh the screen here. Okay, right now we're at 41.2436, down 1.53%. So again, 41.2436. So we right now are below that 41.25 level. But again, it's the daily closing prices on the daily charts that matter. And let's jump back over here. So, okay, so on the hourly candles, you can see here the body of the candle that's active right now after 11 o'clock, right? 11:02 right now, has dipped below, of course, the body of the candle from the previous hour right there. So again, on the hourlies, as long as we stay above 41.20, we're going to be fine. And as long as we stay above on the closing basis on the daily candles, as long as we stay above 41.25, we're going to be fine. But if we do start to close below 41.25, a logical assumption would be to expect the S&P 500 to pull back to the 50-day moving average. And you can see we have pulled back to the 50 right here. We closed beneath it for 1 day right here back in March. We pulled right back to the 50 in the latter part of January of 21. And then, of course, in end of October, beginning of November, we were below the 50-day moving average for a few days back in 2020, again at the end of October, beginning of November. So 41.25 on the closing basis, keep an eye on that. And now let's move on to the triple Qs. The next chart that we're going to look at is a daily candlestick chart of the triple Qs. Of course, that's the ETF that tracks the Nasdaq 100 index here in the U.S. This chart goes back to the beginning of August of 2020. First thing I want to point out is, as of right now, today, the triple Qs are down 1.37%, and today we started to trade beneath the 50-day moving average. Up to this point, since really the beginning of April, we were trading above the 50-day moving average. That is this blue line here, as you can see. But today we have fallen beneath the 50-day moving average on the triple Qs. And if we move to the left, we can see where I've circled this candlestick, which is the trading that happened on January 20th of 2021. We are trading really below, right, where we closed on the 20th of January. So the triple Qs are trading at January levels. We basically have been going sideways since really the beginning of the third week in January on the triple Qs, and tech, at least for right now, has lost its leadership. So in the short term, this I view as a very weak sign for the markets. However, and I'm not really going to talk about it on this video, but we know that materials, energy, industrials, financials, they've really been what's propped up the market. The technology area, which normally is one of the strong areas of the stock market, so far, as we can see in 2021, tech has weakened and it's lost its leadership. Tech has lost its leadership. One of the things that I think is really hurting the triple Qs in the short term here is the fact that there are a lot of very high multiple, high PE stocks in the triple Qs. So in the short term, that is what's probably going to weigh down the triple Qs. In the long run, we should expect the triple Qs to be one of the best performing investments out there. It's just the nature of the construct of this investment, but it can be a very volatile ETF, as we can see. The next chart that we're going to look at is a 9-month daily candlestick chart of the IWM. The IWM is an ETF that tracks the Russell 2000 Small Cap Index here in the U.S. And first thing I want to point out on the IWM over here on the right is we are down 1.32% so far for today. Again, it's just a little after 11 o'clock Eastern Standard Time on Tuesday, May 11th. And where we are trading right now, if we move to the left, we can see that we're trading really about the same place we were in the middle, right around the third week of January of this year. So much like the triple Qs that we just looked at, the IWM has gone nowhere and is just trading sideways and has traded sideways since the third week in January. Now, one of the things on the daily candlestick chart that's really sticking out to me is the potential for a head and shoulders reversal pattern forming here, okay? So what I'm seeing is here is the left shoulder, here's the head, and here is the right shoulder. And this diagonal line, slightly diagonal line, is the neckline. So what we have to watch on the IWM is if over the next few days or whenever it happens, we start to close on a daily basis beneath this neckline, that would confirm that this is a head and shoulders reversal pattern. And generally, those are, they can be kind of ominous patterns, right? So if we start to break down below this neckline, further downside is definitely possible. And if we look over here from a traditional technical standpoint, probably dropping down to at least, I didn't put any lines here, but at least, 200 to maybe, the 192, 192.50 level, as we can see right here. All right. So if this indeed, this pattern, this head and shoulders reversal pattern on the IWM is confirmed by the fact that the IWM starts to close on a daily basis beneath that neckline, then we should expect the IWM to fall down somewhere below the 200 mark right here, the 200 level, price level, and perhaps down into the low 190s or even further, right? We don't know. But as we can see, small cap and technology stocks right now have lost their leadership role. And that, in a short term anyway, is not necessarily the most bullish sign. However, on the S&P 500, as long as we continue to close above 41.25 on a daily basis, there's not a whole lot to worry about. The next pullback area would be that 50-day moving average right around 40.50 right now, and then the next logical place for the S&P 500 to pull back to 39.75. And if 39.75 doesn't hold up, then we possibly could see the market pull back all the way to the 200-day moving average, which right now is setting just slightly below 3,700. Want more charts? Want access to proprietary market information? Want to minimize the likelihood you will experience catastrophic losses in the market? To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com, and I will also leave a link to this site in the description box below this video.